My next guest says if mortgage rates stay above 7%, home sales will continue to falter. Joining me now is Moody's Analytics chief economist Mark Zandi. Mark, it's good to see you. And I want to actually start on the pricing because we haven't seen that budge much. But if I'm not mistaken, Diana just said it was down 17% year on year. What do you make of that?
Yeah, builders are aggressive. I think the median price is close to 400K. If you go back a year ago, it peaked at close to 500K. So that's, 15, 20%. And that goes to the buy downs that Diana mentioned, and they're just being a lot more aggressive. And that's why new home sales have kind of hung tough. They've kind of leveled off, but they really haven't declined all that much. Most of the weakness in sales is on the existing side, where homeowners are much more reluctant to cut price. So builders are doing what it takes to move those homes.
Are they, Diana, going to translate those price declines into the existing home sales market, you think?
No, I actually don't think so, because you've got that supply and demand situation there where there's just nothing for sale on the existing home market, because you have potential sellers saying, why would I trade my 3% rate for even a low 7% rate? But I'm interested, Mark, we are seeing more rent declines in both apartments and single-family rental homes. Do you think that's going to juice the market, or have renters, because they've been paying so much up to date, not have enough savings to get into the housing market, whether it's existing or new homes?
Yeah, you're right. Rents have gone flat to down, particularly at the high end of the market. These big multifamily towers are going up in the big urban centers in the Northeast, Chicago, on the West Coast, and that's putting downward pressure on rent. And that, I think, is having some impact on new house prices. And at the high end of the single-family housing markets, you mentioned single-family rental. There we've already see some weakness. So I think that is a sign that we will see the weakness in prices kind of broaden out here. Ultimately, all of this is going to make it more difficult for existing home buyers to not cut price. I think at some point they're going to need to sell their home because due to life events, divorce, death, children, job change, and when they do, they're going to have to cut price because they're going to get a lot more competition from other sources of housing.
So you think those other sources of housing market, because a lot of people would say, the home buyer is idiosyncratic, and, even cheaper rents, for instance, won't really be much competition.
No, well, maybe on the, you're right to some degree, but I think it's on the margin. Single family rental, people, they can get the same kind of lifestyle in a single family home and rent. And if they get a better deal there, then if they go out and try to buy, they'll do it. And also, more options. As Diana pointed out, there isn't a whole lot of inventory out there for existing homes. So I think we are seeing people use the single family rental option as an alternative. So it is competition, not one for one, but I think it will play a role.
Did we ask you before, Mark? I can't remember. I know Diana and I thought it was maybe where we said, what's the number? What's the trigger where you think that a lot of inventory comes flooding back onto the market? It kind of unlocks the buyers who might be waiting to move. Is it 6% mortgage rate handle? Is it 5%? What do you think?
Yeah, I think Diana was trying to create some drama last time I was on.
What?
I can't quite remember.
Drama?
She disagreed with me. Mark, I disagree with you, but I don't think she really did. I'm not really sure. I can't quite remember.
No drama. Never. No, I don't think 6% is really going to, I think maybe low 6%, but I think 5%, that's where the builders say that they're having to, cut the rate down to, because, look, 7% is not doing it. We saw it go from 8% to 7%, and you still saw new home sales drop. So I think you got to get into the high fives, or at least the very low sixes. Mark, you?
Yeah, obviously 5 is better than 6, no doubt about it. But I think, everybody should get used to 5.5 to 6, because that's where mortgage rates are going to settle in long run. The 10-year Treasury yield, probably 4, 4.5, and then a typical spread of mortgage rates above Treasury, we put them at 5.5 to 6. So that's kind of long run where mortgage rates are going to settle in. So I think that's kind of sort of where we all have to get used to seeing. I suspect you're right, Diana. 6, things start to come back to life, but I don't think we get home sales back to anywhere close to where they were, pre all this, until we get back down to closer to 5, at least for a while. The other thing that's got to happen here, obviously, is we do need to see some weakness in house prices. If house prices don't come in to any degree, we're going to have to see even lower mortgage rates to get sales up. So we need, and no recession, obviously, and incomes have to continue to rise. So, all those three things will determine, exactly, what has to happen with rates and with prices.